We continue to be in a risk-on environment where most of the asset class are up year to date. Despite this deceptive calm, there are some underlying trends which are worth mentioning. Three big key messages I want to leave you with you. First one, geopolitical and political noise continue on the rise. We have had hurricanes, Brexit negotiation, Trump administration unable to get things done, and we have had also North Korea turbulence picking up. Despite all that, market seems very, very relaxed, ignoring most of the negative news. Central banks are also going to intervene, trying to pull out all the supportive that they have been giving during many, many years. Why is this the case? My second point. Both macroeconomic and microeconomic data has surprised to the upside, with reporting season coming and double-digit earnings growth expectation as we were hoping for. In the US, despite Trump, consumer confidence is at one of the highest levels that we've seen, and the consumer is not leveraged. In Europe, the unemployment rate is at levels where it was before the crisis, and every single data we are getting is surprising to the upside. This is the anchor of markets and the thing that will support the turbulence at the geopolitical level. Third, and not for that less important, volatility seems very low, but there are some underlying trends. That's why we mentioned deceptive calms, which are worth mentioning. The weakest link this summer has been currencies, where we have seen volatility in FX that normally goes together with fixed income volatility. We haven't seen it, not even in equity volatility. That's why some market participants are mentioning that due to this low volatility in equities, equities might be the new bonds. But within equities, there's also big sector dispersion. Technology and healthcare, where we have a positive view, continue to do well, while other sectors such as telecoms of energy have been underperforming all year long. We have reached one of the highest levels in technology. Technology valuations are still far where they were in the dot-com bubble, despite the indexes being at the same level as they were before. The big difference is the big companies like Amazon or Google generate huge amount of free cash flow. And that's why we continue to favor that sector. To conclude, we continue to be in a risk-on environment as long as macro and micro data continues to be supportive. We continue that is the case. It's a perfect environment too for active management. Regarding fixed income and FX, we have seen the volatility pick up in FX. We would not be surprised to start seeing some volatility in fixed income, and that's why we continue to be underweight in our fixed income portfolios.